Morning everyone, I'm going to talk you through some trading on the DAX, some trading that I did this morning on the DAX, and as you may know, one of my favourite chart patterns to trade is the double top, the double bottom, the head and shoulders top and the head and shoulders bottom. And I'm going to talk you through first of all just some misnomers, some misunderstanding that traders have with regard to the type of setup that you're looking for. And so the typical, if you like, head and shoulders top or double top, double bottom, you might think you'd be looking at something like this big uptrend, and then you'd be looking for a double top at the top. So high here and a lower high, and then the market comes right down and goes down forever. Well, that's not very often what happens. Not very often what happens. It's very rare for that to happen. Chart patterns have they all have their own unique risk and reward setups. They have we call it a measure rule, if you like. It's a rule that you can use to measure the trades. And very often what you find with double tops and double bottoms is that you get this kind of action. You get a double top and it comes down to here, and then it carries on going up again. And that's more often what you find. So you're looking for the trade to take place because of that type of price action, and you get a reward of this. Okay, so in a little bit more detail, this is the type of thing that you see. You see that type of thing. So you've got a high HH, high there, and a lower high there. So that's higher than that high there. And the entry is below the middle of the pattern here. And so you take your entry here, short. So you go short here. And what you very often find is that you'll get some sort of reaction here, and then the market will go down. And it won't carry on going down forever. It'll go down. It'll take you to your target. And if you want to understand about targets for the various chart patterns, then we've got all that written down in our courses, and we're explained in detail for you in there. And so you get your trade, and then you're out of the trade here because you've got your target. This was your target. Here you've got your target, so who cares what happens next because you're not in the trade. And that's very often what you find then, is that you find that the double tops and double bottoms, and they're double tops, but the double bottom patterns work in exactly the same way, in that they go on for a certain length of time and then they're over. And so it doesn't necessarily, a double top, a double bottom, a head and shoulders top or bottom, doesn't necessarily end a trend. It temporarily pauses a trend perhaps, but it doesn't necessarily end a trend. Okay, so I'm going to talk you through some price action now, some price action trading is what I do. So I'm going to talk you through some price action to help you understand this concept in a bit more detail. The idea behind trading tops and bottoms is to take advantage of natural discrepancies in supply and demand. So what I mean by that is that if the market is doing this, then you've got supply at the top and you've got demand at the bottom. Okay, so what I mean by that then is that people are buying at the bottom and they're selling at the top. Okay, and that's how markets move. They move up and down according to supply and demand. And the demand is greatest when the market is at a low price, and the supply is greater when the market is at a higher price. I hope that makes sense. And as I've said before, very often the market isn't in a horizontal range, it's in a slightly sloping range, and the same rules apply. So you need to decide where the tops and bottoms, where the supply and the demand is. And there are some tools that are already within the indicators that are provided probably with your charts that will give you some clues as to how to judge supply and demand without you having to draw straight trend lines or trend channel lines. I'll talk you through that in a minute. Okay, here we go. All right, so let's have a look at this then, because this is the price action on the DAX up until 9 o'clock UK time this morning. So you can see, because the chart goes down from left to right, that the market's been in a downtrend. And market opened here at 8 o'clock, this big range bar here. And when you get a bar like that at the open of the market, it's a range bar. I say it's a range bar because it's got a middle here and it's got a nose and a tail here. So the candlestick has got spikes at either side, and it is effectively a big 1 minute trading range. Okay, and that's probably likely to preempt what you're going to get in the market that follows it. So you can expect, normally, nothing's ever always the same in trading, but normally when you get a bar like that that starts the market, then you find that the market will quite often mirror that type of price action on a longer term scale. And so I could expect this morning that the market was likely to be in some kind of trading range, and actually that's the way it turned out. But up until 8 o'clock the market had been moving downwards. It had been making lower highs, lower lows, lower high and lower low, and it had been moving down, so it was in a downtrend. You'll see that I've got 3 moving averages, exponential moving averages on the screen. I've got the 8, the 20 and the 90. So this is providing me with context, especially the longer term EMA provides me with longer term context, which means that this is the 1 minute chart, but I don't need to look at the higher time frame charts because I've got this 90 exponential moving average, which allows me to judge where the supply in this case is likely to be. So the market has been trading below the longer term exponential moving average, and that means that when price comes up to that moving average, it's likely that there's going to be a lot of supply at that level, and that's what happened. As you can see, supply here, the market went down, here market went down, and it came up and pierced that level, the exponential moving average. Does that mean the market's going to go up? No, because it's in a downtrend. It's more likely to go down because there's going to be supply here, and there was supply here as well. So what we had here is we had a double top. We had a high and a lower high and a middle. Okay, so effectively we've got high, higher high, let's call it a higher high, lower high and a low here. Okay, so the market's made a low here, a lower high here, and so when it goes below this level here, as it did at this point here, as when it goes below this low here, then it means that it's got a lower low, and so it doesn't have to close below this level for the lower low to be relevant. And it also means that you've got the lower high confirmed. Okay, so what I mean by that is this is a higher high because there's a high here, so that's a lower high, but that's a higher high, a lower high, and the lower high is confirmed when the market goes below the low here. So you've got a lower high and a lower low confirmed, and that means that the market is confirming the downtrend. Okay, so we've got this pattern. This is the double top pattern here. It's in a downtrend, so it's not at the top of a big long uptrend, but it's confirmed because the pattern's confirmed because it's reached a high, in that it's reached a supply level, supply line, as I like to refer to them in terms of the moving average, the exponential moving average. So when the market goes below this level, then you're entering a trade, as I did. And do we expect the market to continue down forever? No, we don't, and especially we don't because of this bar here, this range bar that opened the market. I'd expect the market to trade in a range, but that doesn't necessarily mean that you're not going to get a good trade out of this double top pattern here. And we actually got target almost exactly on this trade. So the entry, let me just get rid of some of these. The entry is below the middle of the pattern here, short, and the target was met just about here. So stop up here above this second high. If the market went up here and above this high, so this second high here, then the pattern is invalid and therefore it's trade's a loss. But the market didn't. The market came down and it took out the target almost exactly before the traders started buying, so demand down here. And so that's how double top and double bottom chart patterns work in terms of the risk and reward. You're looking at about, for these type in a trading range, you're looking at about a 1-to-1 risk to reward, but they are, I find, if you get the criteria right, then they are high probability, they pay off, they come off very frequently. Okay, so that's the first trade of the day, and I'll just get rid of some of this. So the market came down, made target, and that's great. First trade of the day. You've got a 12,000 round number level here. So the market comes up and then comes back down again. And so you may be wondering, okay, this is a downtrend. This is a downtrend, and you've got a low and another low here and a middle, and there's white space looking pretty good. Is that a buying opportunity if the market goes above here? If it goes up, goes above here, is that a buying opportunity for a double bottom? Well, it could be considered a double bottom. The only trouble is that this low looks as though it might be slightly lower than this low, although the bodies of the candles are obviously higher. And the other problem is you've got this 12,000 round number level, and you've got a downsloping exponential moving average in the way of the target, because we'd be looking for a target of the difference between the low here, the high here, where you would get in if you were taking this trade, and the market would have to get past this exponential moving average. So for me, I didn't like the look of that setup, and I continued to look out for double tops. So the market moved on. You can see that it's moving up to this 12,000 level here, and the middle of the potential double bottom trade here that I don't like the look of is about to be taken out. And you can see how close it is now to the exponential moving average, and you're almost certain to get some sort of reaction from that particular level. So just moving on. So you can see the market did go up. It got a big green candlestick bar followed by supply, and the market started going down again. And this is a big green bar followed by a big red bar, and it's at the 12,000 level. And so when the market comes in and tries to go up again and fails, then you've got a potential double top pattern here. And took this screenshot of the price action just about as I was getting ready to enter my short trade, as if the market, which it did, but we'll see in a minute, but as the market pierces the low of this mini double top. Now, these are 5-point gaps between these prices here, 5 points, and this is the, you know, a 6-7 point target is about the absolute minimum that I'd consider, because you've got the spread to take into consideration. That's a fee that the broker charges. You've got that to take into consideration. Also, you may get an imperfect entry, so you need to have very high probability on these trades to consider trading with a target of less than, in this case, in points terms, 7 points. If it was a 5 point target, I wouldn't bother. So stop would go above here, entry just here, and we'll be looking for the market to come in and take out the target at just about this level here, something like that. So let's have a look and see what happened. Okay, so the market came, this was where we were, so we've got our entry below, let's just move that up. We've got our entry in this candlestick bar here. We've got the protective stop above this candlestick here, and the market came up, almost took the stop out, and then came down and took the target out to almost exactly the price that was required. So really, really tight on that one for the target, but this big, massive red bar here just about reached target for that particular trade. So that was the double top within here. High, came down, put a middle in, lower high, market came down and went back up again and almost took out the stop, but it's got the supply again above this exponential moving average. These are, you know, they often act as some form of support or resistance when the market is moving up or down. When it's, you know, when it's in a trading flat horizontal trading range, then you'll find that the market just goes up and down above these exponential moving averages, and they're no use at all in terms of support and resistance. But when you've got a sloping line like this, then, and the market spends most of its time above or below it, in this case it's below the 90 moving average, then they can act as supply and demand lines, and we got that, and a massive red bar enabled us to take a good profit from that particular trade. So let's just move the market on a little bit further. So here we go. This is the market stalled here and started moving around, and you can really see the trading range here. There's no direction in the market at all. It's still meandering down, but it's generally flat. You've got a low here, slightly higher low, and if you'd have taken the double bottom trade here, you'd be starting to get a bit nervous, because you'd have entered here and the market's bouncing down at the moment, still continuing to bounce down, but every time it gets down to around these levels here, the market is being bought at the same time. So general direction down. I don't fancy long trades in this particular situation, with the price action taking place generally below almost all of the EMAs. Okay, so here we go again, move the market on slightly, and this was our potential double bottom trade here. Still hasn't met target, and we're just about here to enter into a short trade again. Okay, so we've got this high here, this high here, and the low here, and the 12,000 level in the middle of it. So as the market comes down, it drops down below the 12,000 level. That was a big red bear bar. This is looking like a big red bear bar at the moment, and the market is potentially putting in a double top above the 90 exponential moving average. So it's a slightly higher risk trade, this particular one, than this double top here. because this top is absolutely identical to this top here. So it's not a lower high, it's an identical high, but you've got the confluence of, in this case, of the market being in a downtrend. And just move the screen on a little bit more, you can see that this was the first high, this was the second high. Entry came below the middle, which was here. So entry came on this bar here, and let me just put those lines on for you. So entry just there, and stop just there. Nearly took out the stop again, and the market has made target here. Okay, so the market's still going down, and my guess at this stage is that it's likely to get bought up at some point in time, but as it stands here, the market's moving down, so still looking out for double tops. Okay, so as people, you know, if you're learning to trade, you'll hear people say, you know, you should take advantage of the fact that markets trend. When they're trending up, they tend to generally move upwards. When they're trending down, they move downwards. And so if you look for double tops in uptrends and double bottoms in downtrends, then more often than not, you're probably going to have losing trades. However, if you look for double tops in downtrends and double bottoms in uptrends, in the small moves that the market may make to good supply levels and good demand levels at the bottom in uptrends, then so supply levels, good supply levels in downtrends and good demand levels in uptrends. If you look for those, then you can definitely find half a dozen of these type of trades a day, and that's going to be enough for you if you really nail these. This is going to be enough for you to just know this one particular pattern inside and out, understand how markets move, understand price action as well. But that's going to be enough for you to be able to make a living from trading. And so beginner traders should focus on one particular aspect of trading, get to know it really, really well, and refine their style, refine their system, so that they can be in no doubt when one of these particular patterns sets up, you can be in no doubt that you're taking the trade. And that's what you need to be. You need to sit there and wait for these trades to appear, wait for the setups to appear, and then take the trade and have confidence that you know, because you keep in your records, you know that 80-90% or 70% even of the time these patterns work for you. And so you take the trade, and if it loses, then you take the loss and move on to looking for the next one. And that's how you'll generally, that's how you'll grow your account over a period of time. And you need to give trading time. So I hope that you've found that useful. Plenty of action. You can see that, you know, I talked about at the beginning the market being in a trading range. Well, these, you know, there are lots of trading range candlesticks in here. It's generally, you know, it's flat. You look at this chart, you look at it, it's from here to here, it's been flat, hasn't it? And it's even, you know, high, higher, high, higher high. It's even been moving upwards, but you still, this was the double bottom, potential double bottom for the downtrend. You still haven't got target on that particular trade yet. You haven't had a loss yet, but you haven't got target on it yet. That's a long time to wait for the double bottom, potential double bottom trade with the entry here to pan out. In the meantime, lots of opportunities for double tops in the downtrend. Hope you found that useful anyway. My name's Anthony Beardsall. Look forward to you joining us at Excellence Assured at the Trading Academy if you're looking to find ways of becoming profitable and trading for a living. I tutor on those courses, As I say, my name's Anthony Beardsall, and I'll catch you on the next video. Cheers for watching.